Hello, everybody. This is Harjinder, and we are going to look at Chapter 4 from Management Accounting 1. We'll be talking about cost, volume, profit. Our learning objectives for this chapter include the ability to explain the concepts of contribution margin, break-even point, and cost, volume, profit graph, to identify the key assumptions of cost, volume, profit analysis, to describe the use of cost, volume, profit analysis, calculate break-even point, calculate sales needed to achieve targeted profits, define and calculate margin of safety, and calculate operating leverage. First, I'd like to talk a little bit about contribution margin and how it's related to break-even. So in Chapter 3, we learned that contribution margin is the difference between sales and total variable costs. Contribution margin per unit can be calculated by dividing total contribution margin by the total units sold. And contribution margin ratio can be calculated by dividing the contribution margin per unit by the selling price per unit, or alternatively, by dividing total contribution margin by total sales dollars. Operating income is total contribution margin minus total fixed costs. Now, at break-even point, the company is neither making a profit nor incurring losses. So the amount of profit or loss is zero. So that can only happen if total contribution margin is equal to fixed costs. So this is an important result to keep in mind. At break-even point, total contribution margin will be equal to total fixed costs. Let's take a look at the cost, volume, profit graph, or the CVP graph. A company needs to recover its fixed expenses before it can start earning any profits by way of operating income. So we can graph the relationships amongst revenue, costs, profit, and volume in terms of number of units sold by preparing what's called a cost, volume, profit graph. This is what it looks like. In the horizontal axis, we have the volume. That's the quantity of products sold. On the vertical axis, we have costs and revenues, and the difference between costs and revenues, of course, is profits. These are all the dollar figures. Now, the company has fixed costs. So even if it were not producing anything at all, you would notice this flat line here represents the fixed cost portion. If the company were not producing anything, it would still have to pay for the fixed costs, here being $35,000, and that would indicate the company would be losing money, losing $35,000 if it was not selling any units whatsoever. Now, we're talking about producing and selling speakers. This is a company that manufactures speakers. So speakers cost money to make. So this here, this line here, the less steeper line, indicates the line for variable expenses. The variable costs to make and sell a speaker is $150. All right. So when the first speaker is produced, the cost will be $35,000 total of the fixed costs plus $150 for each speaker produced, right? So gradually, as we make more speakers, it'll cost more and more. So 100 speakers will have a variable cost of 150 times 100 of $15,000. So you can notice here at 100 speakers, the total cost, it's $50,000. How is it 50,000? $35,000 for the fixed expense cost, for the fixed costs, and $15,000 for the variable cost. As we move from 100 speakers to 200 speakers will have a variable cost of 30,000 plus the $35,000 of fixed costs. You're hitting 65,000. So you notice gradually as more and more speakers are produced, the total variable cost goes up and the total cost also goes up. Now, the company sells speakers for more than what it costs it to make. So this graph here that starts from the 0 point and it's steeper than the variable cost curve is the revenue curve. So as more and more speakers are sold, the company earns more and more revenue. At a certain point in time, the revenue curve, the revenue line, intersects or cuts through the variable cost line. And at this line, when the intersection occurs, that point is called the break-even point. For this company, the break-even point occurs at 350 speakers sold, that's the volume, or in terms of sales, this is the midway point between 75,000 and 100,000, so $87,500. After this point, the company will be in the profitable area. So the more speakers sold beyond 350, the company will earn more profits. Now, in this course, in Accounting 3224, we are not going to be resorting to preparing graphs. Instead, we will calculate break-even point and other related computations in another way. Let's take a look at the assumptions of cost volume profit analysis. One assumption is that the selling price stays constant. And that selling price is indicated by the slope of the revenues line, right? So if the selling price were to change, the slope of the revenue line would not stay a straight line, it would have changed. So this is not an unreasonable assumption in the sense that in the short run, companies will not tinker with selling prices. Another assumption made by the CVP analysis is that costs are linear and they can be divided into variable and fixed components. We saw in chapter 3 that costs can be either variable costs or fixed costs. Sometimes costs may be mixed costs, i.e. share features of variable and fixed costs, but it is possible through the use of high-low method or linear regression analysis to separate the mixed costs into variable and fixed components. So again, other than the bit about the costs being linear, sometimes they're not exactly linear, but to the extent that we are able to use the components, the variable and fixed components we get from the high-low or the least square analysis for estimation purposes, this again is not an unreasonable assumption. For products, for companies that have more than one products, the assumption made is that sales mix is constant. In this course, in Accounting 3224, we actually do not get into the multi-product firm analysis. So this assumption for us is does not apply. For manufacturing companies, we make an assumption that there's no buildup of inventory and that the number of units produced equals number of units sold. This is possibly the weakest of the assumptions because quite often it happens that companies tend to produce more than they manage to sell. However, in the short run, we can accept this assumption as being okay because in the short run there will be no massive buildup of inventory. We can accept this assumption as tenable, but in the longer run, this assumption might fall apart. So one thing to keep in mind is that CVP analysis is only really applicable, or the results from the CVP analysis are only really applicable in the short run. So why would we want to use cost volume profit analysis? CVP analysis can help us in doing something called incremental analysis. Now, what incremental analysis is about is it's an approach that focuses on specific moving parts that will cause a difference in a decision. So those moving parts relate to revenue, cost, and product volume. And so how the movements, the intermovements between revenues, costs, and volume can have an impact on a company's profit and consequently alter management's decisions is the focus of incremental analysis. And we will be learning more about it in this chapter. So, as example, cost volume profit analysis can help us in predicting the impact of changes in fixed costs and sales volume. So if fixed costs go up, it has an impact on the company's break-even point, assuming selling price and variable costs do not change. Similarly, if sales volume goes up, the company's total contribution margin changes. So we will sometimes be looking at situations where it is being recommended that the company increase the overall advertising budget. Advertising is a fixed cost. So if the company increases its overall advertising budget, if it is predicted that there will be an increase in the number of units sold, we can take those two moving parts into our analysis and see whether it makes sense for the company to do so. We would be looking at changes in variable cost and sales volume. So stuff like, okay, if our workers are asking for a higher wage rate, that will have an impact on the direct labor cost. How will that have an impact on our total overall profitability? Can we try to increase the selling price? In microeconomics, you folks learned about um, um, the elasticity of demand. So if the selling price increases, the quantity demanded of a product may fall. So in order to decide whether that would be a wise route to go, often calls for this kind of analysis. We'll be looking at changes in fixed cost, selling price, and sales volume. We'll also be looking at changes in variable costs, fixed costs, and sales volume. And finally, changes in selling price. A whole bunch of changes, either one change at a time or multiple changes together. So how do we decide whether a change should be implemented or not? The driving decision rule is that you would make the change if, as a consequence of the change, the increase in contribution margin is greater than the increase in fixed costs. So it's basically down to the cost volume profit cost benefit analysis rather. So if the total costs of the decision are less than the total benefits from the decision, you will go ahead and make the change. Otherwise, you would not. You could also be looking at a situation where we are looking to lower costs, and those actions can have an impact on contribution margin going down as well. In that case, the benefit will be the decrease in fixed costs. So in that case, what you'd be looking at is if the drop in contribution margin is less than the decrease in fixed costs, then it would be advantageous to make the change. So bottom line, you want to look at the facts closely in order to decide whether a change is welcome or it should be avoided. Calculating break-even point. So recall that at break-even point, total contribution margin equals total fixed costs. Now, because total contribution margin is nothing but sales minus variable costs, we can rearrange that relationship and say that it's basically sales at break-even point, sales revenue is just enough to cover the variable costs and the fixed costs. And that is why there's no profit left over. So the break-even point in terms of units is calculated by dividing the fixed costs by contribution margin per unit. The break-even point in sales dollars can be calculated directly by dividing fixed costs by a product's contribution margin ratio. However, I tend to do the calculation just a little bit differently. I tend to say, first calculate the break-even point in units, and then multiply that break-even point in units by the selling price. So we'll take a look at that soon. Here's an example. So this company, Mauro Products, distributes a single product, a scarf, that has a selling price of $15. Variable cost is $12 per unit, and the monthly fixed expense is $4,200. We've been asked to solve for the company's break-even points in unit sales, the first bit. Okay, so if the selling price is $15 and the variable cost is $12 per unit, the contribution margin per unit works out to selling price $15 minus the variable cost $12, $3 per unit. Now at break even, remember, the company can only cover, like the company would not be making any profit or loss. So its total contribution margin will therefore be just enough to cover the fixed costs of $4,200. So total contribution margin is basically the contribution margin per unit, $3, times the number of units sold. So how many units does this company need to sell such that at $3 for every unit sold, it will have earned total contribution margin to cover fixed costs of $4,200. Well, that is $4,200 divided by 3, 1,400 units. That's our break-even point in units. Part 2 asks us to solve for the company's break-even point in sales dollars. So the break-even point in sales dollars is the number of units, so 1,400 units that we need to sell in order to break even, times the selling price per unit, which is $15, and that gives us $21,000. Okay. Part 3, if Moro Products decides to drop its selling price to $14 with no change to the variable cost per unit or fixed costs, what will the new break-even point in unit sales be? So this is taking a look at a change in the selling price. So if the selling price goes down to $14 with the variable costs and the fixed costs remaining constant, that is going to have an impact on the break-even point. Why? Because now, if the selling price is lower, the contribution margin per unit will be $2. So our break-even point in units will work out to 2,100 units. We still have to recover $4,200 in fixed costs. But now each unit sold can only bring in $2 in contribution margin. We'll have to sell more units to break even. And in terms of sales dollars, our break-even point actually goes up quite a bit from $21,000 before to $29,400 now. So that is an important takeaway, that if the contribution margin per unit decreases, it will have an impact on break-even point. The break-even point in unit sales will go up. The company will have to work harder, sell more units in order to break even. Okay, next up, we'll take a look at targeted operating income. So the relationship here will be that we knew that break-even point, at break-even point, sales was equal to variable and fixed costs added together. So if there is going to be any operating income, sales must be higher than the break-even sales, right? So sales will be equal to variable expenses plus fixed expenses plus the targeted operating income. Now, if sales goes up, we know that variable costs will go up. So it is better to look at contribution margin. So essentially, if there is a targeted operating income to be earned, we want to look at total contribution margin being enough to cover the operating income and the fixed expenses. So often you'll be asked in questions, how many units must be sold to achieve a specific targeted operating income? The calculation there is you want to add the fixed costs to the targeted operating income and divide the sum by contribution margin per unit. Similarly, sometimes you're asked to calculate the sales in dollars to achieve the targeted operating income. And the sales in dollars there are the fixed costs plus the targeted operating income, the sum divided by the contribution margin ratio. Net income, recall, is income after taxes. So if a company has a tax rate of 40%, then its operating profit of $100 will result in income tax of $40, and thus the net income will be $60. So it's important to look at the relationship between net income and operating income or operating profit. Net income is operating profit minus taxes. The income tax amount is calculated based on operating profit. So that's basically operating profit times the tax rate. A little bit of algebra gives us net income being operating profit times or multiplied by 1 minus the tax rate. So if you try to apply it here, our operating income here was $100. Tax rate is 40%. 1 minus 40% gives you 60%. 60% of $100 equals net income of $60. All right, so keeping this relationship in mind, if we are asked to calculate the unit sales needed to achieve a targeted amount of net income, the formula is fixed costs plus the targeted net income divided by 1 minus tax rate, the whole sum divided by contribution margin per unit. If we are asked to calculate the dollar sales, then it'll be fixed costs plus the targeted net income over 1 minus tax rate, whole thing divided by contribution margin ratio. I have an alternative approach which does not require memorizing the formula. So it is basically a visual approach here. So the total contribution margin, the word contribution, if you think about it philosophically, it indicates the amount that contributes first towards covering fixed costs. So contribution margin goes first towards covering fixed costs. And whatever's left goes towards operating income. So if we are asked to do calculations for a targeted net income, we have to convert that targeted net income amount into a targeted operating income. And that is done by dividing the targeted net income by 1 minus the tax rate. So targeted net income divided by 1 minus the tax rate gives us the targeted operating income. Add to that the fixed costs, we get total contribution margin that the company has to earn. If we divide this total contribution margin by the contribution margin per unit, we get the number of units that will be needed to achieve the desired outcome. Okay, so we will be looking at an example. So first example is exercise 4-6 from the textbook. So this company here makes and sells just the one product with a selling price of 100 and variable cost $80 per unit. The monthly fixed cost is $20,000. We are asked to solve for the unit sales needed to earn a target profit before taxes of $3,000. So this is important for you guys to remember. If it says before taxes, they're talking about operating income. If they say after taxes, then they're talking about net income. Here, they mentioned before taxes. So this is operating income of $3,000. The contribution margin per unit is fairly straightforward. $100 is the selling price. $80 is the variable cost per unit. The contribution margin per unit is 100 minus 80, $20 per unit. Okay, so in order to make the targeted profit of $3,000 before taxes, this company must first recover its fixed costs of $20,000. If its total contribution margin was equal to $20,000, then it would break even. In order to earn the profit of $3,000, the company must earn an additional $3,000 of targeted operating income. Added together, we get total contribution margin of $23,000. This company must earn total contribution margin of $23,000. Now look at it. Total contribution margin 23,000 minus fixed costs of 20,000 will be equal to $3,000 of operating income. So this company needs to earn $23,000 in total contribution margin. Every unit that it sells brings in 100 minus 80, $20 in contribution margin per unit. So divide the total contribution margin by contribution margin per unit of $20, and we get the number of units that this company needs to sell to earn its targeted profit. 23,000 divided by 20 is 1,150 units. So sales units needed, 1,150. Next part, same facts. Solve for the dollar sales that are required to earn a target profit before taxes of $4,000. So again, it's before tax profits. So in order to get there, the company must recover fixed costs of 20,000 plus the targeted income of $4,000. Added together, we get targeted total contribution margin, $24,000. Each unit brings in $20 of contribution margin. So the number of units to be sold is 12,000, or rather 1,200. However, that's not what the question asked. The question asked for the dollar sales needed. So sales in dollars. So 1,200 units must be sold. Each unit is sold for $100. So the sales dollars needed is 1,200 units multiplied by $100 selling price, or $120,000. Third part, same facts. And in the third part, we are asked to calculate the number of units that need to be sold to earn an after-tax income of $6,000, assuming a tax rate of 25%. So this is after-tax income. After-tax income is net income. So we want to earn after-tax income of 6,000, and we're given a tax rate of 25%. So how does this work? If my operating income were 100%, my income tax will be 25%, meaning net income, the after-tax income, will be 75%. So I have to first convert the after-tax income into a before-tax operating income. Okay? So to do that, I essentially say 75% of my operating income should be 6,000. So operating income, therefore, should be $6,000 divided by 75%, or 0.75, to get $8,000. And that's basically the required net income, 6,000 divided by 1 minus the tax rate. Tax rate is 0.25. 1 minus 0.25 gives us 0.75. 6,000 divided by 0.75 equals $8,000 in before tax operating income. Once we've calculated that amount, the rest is fairly straightforward. The company must recover its fixed costs of 20,000 and earn the targeted operating income of $8,000. That means the total contribution margin needs to be 28,000. Each unit brings in $20 in contribution margin. So the number of units that need to be sold equals 28,000 divided by $20 per unit, 1,400 units. The answer to this question, 1,400 units in sales, is needed to earn the after-tax income of $6,000. And we can check the math. If the company earns a contribution margin of 28,000, its operating income will be 28,000 minus 20,000 fixed costs, $8,000. Income tax will be 25% of 8,000, or $2,000, and you'd be left with net income of 6,000. Next concept is that of margin of safety. So margin of safety relates to the excess of budgeted or actual sales over the break-even sales volume. It's the amount by which sales will need to fall from the current situation before the company hits break-even point. Any further decline in sales will mean losses. So how safe, how far removed is the company at present from breaking even or falling into loss-making territory? Margin of safety can be expressed either in sales dollars or as a percentage of sales. So the calculation is total budgeted or actual sales less the break-even sales. As a percentage, you will divide the margin of safety in dollars by the total budgeted or actual sales. So continuing with the earlier example of 4-6, and I'm adapting that example, same facts as before, and I say, what is the company's margin of safety if it sold 1,800 units last month? So to answer that question, you will need to calculate the break-even point. So remember, at break-even point, the company does not earn any operating income or loss. It must still recover its fixed costs. So fixed costs of 20,000 plus targeted operating income of $0 gives us total contribution margin of $20,000 that the company has to earn in order to break even. Divide that by $20 per unit of contribution margin, you get break even point of 1,000 units. So the company has to sell 1,000 units in order to break even. From that, to get to the margin of safety, we will subtract from the current sales the break-even sales. So currently, if the company sold 1,800 units and the break-even is at 1,000 units, the margin of safety is 800 units. If the question asked us margin of safety in sales dollars, you take the 800 units and multiply by the selling price of $100 per unit, $80,000. So sales will have to fall by $80,000 before we hit break-even point. If you were asked to calculate margin of safety as a percentage, you will divide the 800 units of margin of safety by the current sales, 1,800, 44.44%. So sales will have to drop by 44.44% from the current level before the company hits break-even point. The next topic is operating leverage. Operating leverage is a measure of the sensitivity of operating income to a given percentage change in sales. So what it does is it can help us predict how a change in sales volume will impact profits for a given sales level. So operating leverage changes as sales levels change. So it is a calculation at a point in time. The formula for calculating degree of operating leverage is you want to divide contribution margin by operating income. And if you were to predict the impact of a change in sales on the profits, you will multiply the degree of operating leverage by the percentage change in sales to get the percentage change in operating income. Here's a look at an example. So this company installs lawn sod in home yards. You're given the most recent monthly contribution format income statement below. Sales 80,000, variable cost 32,000, give us contribution margin 48,000, fixed cost 38,000, resulted in operating income $10,000. So first part said calculate the company's degree of operating leverage. The degree of operating leverage is basically contribution margin divided by operating income. So 48,000 divided by 10,000 gives 4.8. Part two, using the degree of operating leverage, estimate the impact on operating income of a 5% increase in sales. So if sales were to go up by 5%, operating income will go up by 5% multiplied by the degree of operating leverage. So 5% times 4.8, 24%. And you can check that math. If sales were to go up by 5% from the current level, contribution margin will go up by 5% as well, because if sales go up by 5%, variable costs, the total variable costs will also go up by 5%. So it is important to look at the change in the contribution margin. If sales goes up by 5%, contribution margin will go up by 5% as well. 5% of 48,000 is $2,400. Because there's going to be no change to the fixed expenses, that entire increase in contribution margin will be experienced in the increase in operating income. So if my contribution margin goes up by $2,400 and there's no change to fixed costs, my operating income will go up by 2,400. So what was a 5% change at the contribution margin level, 2,400 as a percentage of $10,000 is 24%. Okay. In class, we will be looking at additional questions. If we are not able to get through all of these questions, I encourage you to try them on your own. Keep in mind that chapter 4 is not covered for the first midterm, rather it is part of the second midterm. So on that note, I conclude this lecture video and